Have a listen to this. Have a listen to this.
Interest rates are higher. I know people don't like that, but you should be welcoming a stronger economy.
And maybe a deal has a point about the machinery of capitalism being oiled with the blood of the
The
worker.
United States is a country that has always paid all of its bills.
Lannister always pays his debts.
Don't let the bastards get you.
Hello and welcome to Comedian versus Economist. We demystify the world of money and help you get a handle on the bigger picture. My name's Adam and we're joined as always by my little older brother and real life economist, Thomas. Hi, Thomas.
Yeah, g'day, Adam. How you going?
Doing really well, thank you. Thomas got some email during the week. Patrick sent us an email. He said, love the show, great way to keep up to date. But I want to ask about your comment that Coles and Woolies margins are single digits. That might be true for Jumbo, but Coles posted a 26% margin earlier in the year. Looks like they're doing pretty well, or is there something in the article that's overstating things? He sent us a link to an article. Thomas, Coles margins actually at 26%. That seems like they would be doing really well.
They are they are crushing. I think that's like at the whole of business level. And like the thing about the Coles and Woolies is they've got a lot of fingers in a lot of pies. They own stuff up and down the supply chain. Woolworths has a media business called Cartology that's worth $500 million, apparently.
Really?
Yeah, so they do
what sort of programming are they putting out? the in-store music. Got some real bangers on aisle 4.
Yeah. No, somehow they're selling ad space to retailers.
Yeah, okay.
Using their data, but I don't really understand it. But it's worth $500 million apparently.
Yeah, wow.
Yeah. So I think that's at the whole of business level. That was in the Guardian, that article that Patrick was looking at. In the AFR, they talk about EBIT margins, earnings before interest and tax margins, and that seems to be you kind of idea that's your core business, the profitability on your core business. And so when the AFR is talking about it, they talk about EBIT margins and saying like in the last results for Woolies, they jumped from 4.7% pre-COVID to 6% in 2023. So saying like profits are up, but we're not heading towards 30%. You know, and it kind of thinks like if you think about we were talking about Ethel's $50 spend in Woolies, they're not making $13 profit.
Yeah, right.
On that deal, like it's got to be more like $2 to $4 would be $3.
Unless she's at the cigarette counter buying durries.
Yeah.
There's some fat profits there.
There probably isn't the data to know, like on a Ethel's $50 spend, how much is actually profit. Yeah, I don't know. There might be a retail analyst out there who knows, but
well, you and him can have an enthralling chat sometime. If you do want to send us an email, cve@equitymates.com. We do love hearing from you. So thank you, Patrick, for reaching out.
Actually, speaking of last week's show, we're talking about the streaming economics. You were going to play Anna 30 seconds of noise like a lawnmower or something and see if she noticed.
Yes.
Did you do your homework?
I did, actually. I did. I snuck a lawnmower track in. Didn't go well, Thomas. There was some initial positive reaction, but that was because Anna thought I was finally out mowing the lawn. Then she saw me still sitting on the couch, and it just made it worse. A massive show coming up, as always. Can we solve insolvencies, or are they unsolvable like Rubik's Cubes? Thomas, active investing is hard. Turns out paying someone to invest for you is also hard. And first, happy hour at the pub stopped being an hour. Now it's stopped being happy. We'll tell you why a bit later on. But first, Thomas, what's Tim Gurner's problem? And follow-up question, who's Tim Gurner?
Yeah, this was an interesting one through the papers this week. So Tim Gurner is a billionaire property developer. I think does a lot of high-rise stuff. Bit of a young gun in the industry. But so he was talking at the AFR's property summit. They had a property summit. And he dropped some controversial things in there, saying that, complaining about people through COVID decided they didn't really want to work so much anymore. And saying that unemployment has to jump 40 to 50% in my view. We need to see pain in the economy, Mr. Gurner said. We need to remind people that they work for the employer, not the other way around.
Right.
Tradies have definitely pulled back on productivity. They have been paid a lot to do not too much in the last few years, and we need to see that change. Yeah, I don't know. There's can't say anything these days.
And this upset
People are
people.
so
Why? I know. Snowflakes. What's wrong with people? Gone are the days where you could just say to someone, you're not doing a good job and you're working far too little for the money you're being paid, and we think you're shit.
Yeah.
And now
I
you
mean,
say it and people get upset.
well, yeah. I mean, obviously, workers were upset by this, particularly tradies. And it was dumb. Like, he employs a lot of tradies, telling them that they're all slackers is not good. The clustering of that, unemployment needs to go up. We need to see pain in the economy. Like, okay, pain. You're not the one going to be feeling that pain as a billionaire. So to say that the economy needs pain, and we need to remind people that they work for the employer, not the other way around. So we need to put people back in their place. Was pretty ooh, but it blew up. So it went off on Twitter. AOC, Alexandria Ocasio-Cortez, the key figure in the Democrats in America, she even retweeted it. So got something like 30 million views or something like that.
Right. Does he just need to work on his messaging though? Like, I feel like you could still get the same message across without kind of being such a dick about it. Like, you instead of saying we need to feel pain in the economy, you could just I don't know, bring some data in there. You did a 40 to 50%, but just keep it factual, and not make it analogous to pain and suffering.
Yeah, that's right. I think he would have been pulled aside by other property developers and said, "Hey, we're not supposed to say that bit out loud."
Ixnay on the pain, yay.
Yeah, it's at some level, he's highlighting the conflict of interest between capital and labor, classic Marxian sense, and saying that, we need more unemployment to put people back in their place. It's that's a pretty, the RBA was, they're saying unemployment probably needs to rise to get inflation under control. People go, okay, to get inflation under control, that's a reasonable reason for unemployment to go up. But to put workers back in their place, that's not okay.
Yeah, I think that's he really missed the rationale point, didn't he? And didn't read the room at all on, it's not like everyone's having a good time at the moment. Do you know, it's the cost of living crisis, people are struggling for money, then to come out and say everyone's got it too good.
Yeah.
when it's pretty widely acknowledged that everyone's got it pretty ordinary. You're not going to get a lot of support. But that's it. Before, I guess, we get too much into Tim bashing, the one thing I probably should check is he actually wrong? Is it just that he didn't go about it the right way, or is there some truth to what he's saying? I mean, is he right?
Well, yeah, I mean, it's interesting. The RBA came out in June, Michelle Bullock, the incoming governor, saying that unemployment would have to rise 20%, so it didn't go to the full 40, 50% for a balanced labour market. But that's in the context of inflation. And I think that's what, if his comments were we need to get inflation down, and that probably means, unfortunately, some people are going to have to lose their jobs, probably wouldn't have gone down so well. When it's we need to put workers back in their box, get them to pull their fingers out and do more work, and we need to get unemployment as a way to discipline individual workers, that's, it's a bit messed up. But also, a reasonably widely held view. That's why I think, it's not something, everyone condemned it. Liberal Party, Labor Party, Greens, everyone's well, okay, that's pretty out there. No, you can't go that far. But then the Minerals Council chairman, Andrew Michelmore, goes, he's not exactly wrong, saying people are living a lifestyle that's not sustainable. Employees have got used to earning the same amount of money but not putting the same hours in. And look, if you're going to produce less, well, I'm sorry, then you have to accept that you will ultimately get paid less. Yeah. You say we need a rise in unemployment to break the cycle. I don't know what cycle he's talking about.
The work cycle. We've got to somehow get everyone out of jobs. Stop teaching kids from a very young age. I remember when I was in primary school, there was a common conversation topic at the recess table was, what do you want to be when you get older? We've got to take that out of the primary school vernacular and remove it from the dialogue that's happening in primary schools all around the country. Right, Thomas, you got some data, some sweet data on business bankruptcies.
Yeah. Business insolvencies are up to a 15-year high, highest level since 2008 global financial crisis.
Right. Has that been a gradual thing? Like, I feel like the GFC was like whack, and then everyone, like, things started falling over. Has this been kind of creeping up? Or is it?
Yeah. It's sort of interesting. I think part of the story is that it's jumped up. Numbers are actually kind of amazing. So by June this year, the end of the financial year, half of the firms that started in 2019 had closed. So like of the businesses that started in 2019, half of them are bankrupt or insolvent now.
It's tough conditions to start a business. It was COVID-19, wasn't it? So,
Mm.
but we got it was COVID-19 because it was discovered in like November.
Yeah.
And so there was no impacts or anyone even thinking about COVID until
2020.
2020.
That's right.
I was going to say it wouldn't be the smartest business decision. Like first lockdown, you're like, I think now's the time. I'm going to
I'll
launch.
launch my boutique travel agency. Yeah, so but between June 2019 and June 2023, 35% of all Aussie businesses closed permanently.
Yeah, right.
It's big numbers. And then this tilts small. So like the small enterprises are much more likely. Their survival rate is 41%. I think for sole proprietors, survival rate of 41%. So only 40 of them survive over 3 years.
Right. Okay.
But those numbers are reasonably normal, I think, and the jump up that we've seen, like, it is coming down to the economy is slowing and things are getting tougher. But it's also, so Gary Mortimer, who's a management lecturer at QUT, said that ended up with a lot of zombie businesses through COVID that were supported by JobKeeper and other payments.
Right.
And now that that's all coming off, they're going like, actually, yeah, we are bankrupt. We're going to have to close.
Because there's a particular definition, isn't there, for zombie companies? There was a big thing, I don't know, I'm going to say a year ago. Maybe is there an index that tracks zombie companies or something along those lines?
Zombies, yeah. You see numbers every now and again. Yeah, Christopher Joy does at the AFR often has some numbers on it, but I don't know. There's not ABS isn't tracking it.
So what should we be worried that this is so high now?
Well, I mean, I think so. It's picked up, and I think that's two things. One is that the economy is slowing, but the second thing is that there's a bit of a lag that bankruptcies actually dipped down through COVID because you had so much government support, and so there's a bit of catch up for businesses that would have closed during COVID if there wasn't COVID, and now are closing now. So there's a bit of a bulge coming through the timeline.
Is any of it? You might not have the answer to this, but is any of it related to sort of the slowdown in cities and, work from home and all that sort of stuff? Like, there would be a lot of small businesses, I imagine, that were sort of operating in the city cafes and whatever, that are probably now just going, well, we're kind of waiting for everyone to come back. but now we've been waiting for like a year and a half.
Yeah.
Numbers are still right down in the city, aren't they? And so
they are that I've seen. Yeah.
So is that contributing, or is that maybe offset by the pickup in small cafes and things that are in the suburbs now? That
I don't have any data on that. I'm not sure. Yeah, I mean, I don't think the CBDs, in terms of small businesses, I don't think that would account for that much of the total stock. But I don't know. That would be my guess. Like, I wouldn't imagine it's huge. It's definitely be contributing, but
fair enough. I mean, I'm happy to take guesses and speculation here, obviously, Thomas. Don't get hung up on data,
I'd say yes. That's the vibe.
Yeah. It's a hard yes from us.
If you're renegotiating your lease on your inner city cafe, tell them 90% of cafes, inner city cafes, are going closed.
And does the RBA think about this, or are they just kind of, they're too big picture for this?
Oh no, they'll be watching this, because this is sort of what you're expecting to see happen. Is that because remember the way we're trying to, like, as we were saying before, the RBA thinks the unemployment needs to go up 20% or odd. That tends to happen when businesses close. So the first domino to fall is businesses, because once businesses get into trouble, then that's when they lay off workers. Because if they have a temporary downturn in revenue, hiring is such a palaver that they'll just tend to hang on to workers for as long as is practical, because they don't want to rehire when things pick up again. So often big unemployment comes with when businesses are closing. So they'll be watching this as, is this potentially the first domino to fall?
Right.
Mm.
What's going to make Tim Gurner and his friends happy then, isn't it?
Yeah.
That's what they wanted.
Yeah.
Brilliant. All right, let's take a break here. We'll grab a quick word from this week's sponsors and be back with more CVE right after this. Welcome back. You're on Comedian versus Economist. You can send us an email just like Patrick did earlier in the show, cve@equitymates.com, or get us on Facebook and Instagram at CVE Podcast. Thomas, more than half of local fund managers, it turns out, fail to beat the market. What's going on there?
Yeah. So we got a report from S&P. They've got the SPIVA research unit. There's an acronym, but I didn't look it up. I don't know what it means. But their research unit, S&P, tracks the performance of active fund managers relative to their indices for over the past 20 years. And they, quote, found most active managers underperform most of the time.
Yeah. That's disappointing. You're better off putting money into like an ETF or something like that, an index fund, than asking someone to
that's the conclusion. So underperforming the indices. So like if you're investing in a active fund manager who's in the ASX, in local equities, their relative benchmark is the ASX 200 or something like that.
Yeah, right.
And what they find is that they don't beat the market very often. For this 6 months to June this year, the second half of the financial year, more than half of equity fund managers in Australia failed to beat the market, which, and you think, maybe that gets better over time. It actually gets worse over time. So once you go out to 10, 15 years, then 80% are underperforming.
What?
Yeah.
That's getting down to like Nathan Brown levels of success.
That's right. You reckon he'll pivot into active funds management next?
Could do. Why not? He's got a following. He's got an audience. Same game multis plus my 3 most highest conviction stock picks for the week.
Yeah, there's a bit of variation in terms of markets and asset classes. So Australian fund managers investing in global equities, they're particularly bad. So only like 5 to 10% beat the market over 10 to 15 years. It's like 1 in 20. Small and mid caps are better, so they have a bit more of an edge. But even then, like it's 50% on the year to date. It's just under 80% are underperforming over the 10 years.
Oh, right.
Yeah, so only just over 20% are overperforming the market or beating the market over a 10-year period in the mid to small equities. Small cap equities. So it's pretty shoddy across the board. So I mean, this is the whole rationale for like what drove the passive investing and exchange traded funds was this recognition, and this this has been well known for a while, that it's really hard to consistently beat the market.
Well, I think Warren Buffett was a big fan of this, wasn't he? I remember he have a bet, a really high profile bet back in the 80s. Kind of said, look, let's have a bet. Next 10 years, I'll back the S&P 500 and you do your stock picks with some other investing guru and we'll see who wins. And Buffett won because he was like, see,
yeah, right,
just track the market. I mean, he's obviously done a bit more than that.
yeah. He's also picked some winners. Are you sure that's Warren Buffett?
He didn't even make 46 billion on BYD or something on the whatever that Chinese car.
He's crushed at some deals by picking winners. Yeah, I'm not sure that's Buffett, but yeah, like we go back to value investing.
I think he was talking to your average amateur investor,
right? Yeah,
and kind of saying, look, you're best off kind of just tracking the market. And again, it comes down to that edge, right? Like unless you've got an edge, which Buffett through 57,000 analysts working for him, arguably has an edge and access to all of the early markets and stuff. Then he could argue he's got an edge, obviously.
That's right. So like not only picking stocks is hard, but if you've got to pick an active manager to manage your money for you, you've got like a 1 in 10. 1 in 20 chance of picking a fund that's going to make you money.
And then you got to pay fees.
Outperformance fees. If they do actually beat the market, you got to pay them for it.
Well done. You know that thing I paid you to do.
Yeah.
Well, you did it. Good job. You're in the top 10% of people. Everyone else couldn't do it, but now, yeah. Outperformance fees. Brilliant. All right, finally on the show today, Thomas, this is something in my wheelhouse. I like this story. UK pubs are trialling something a bit radical. What are they up to?
Yeah, so they're doing surge pricing on pints. So Stonegate, which is Britain's largest pub owner, they own 4,000 pubs, including the popular Slug and Letters chain.
It's got to be the something and something.
So,
It's a British pub, right?
Yeah. Pig and Whistle.
Pig and Whistle, Elephant and Wheelbarrow.
Yeah, I wonder where that comes from.
Probably two families getting together and their shields. They're like,
okay. Yeah, okay.
No, it's not. I just made that
Right.
up.
Let's go with that. Yeah, but they're going to introduce surge pricing for pints. So they're trialing it in 800 of their 4,000 pubs. Well, they're not calling it surge pricing; they're calling it dynamic pricing.
This can't be real, surely.
Yeah.
It has to be fake. You can't have dynamic pricing happening in pubs. People are going to get absolutely outraged. You go for a pint and then 10 minutes later it's gone up.
Yeah. I mean, they did get a quote from Tom Stainer, who's the chief executive of Campaign for Real Ale, which represents pub goers in Britain. Classic. I've got a union representing pub goers. But yeah, he's saying pubs are places we expect to walk in and know what you're going to pay for a pint, regardless of the time of day.
Yeah. It's hard enough keeping track of petrol prices, let alone beer prices.
Yeah.
And just like petrol, it's an essential item. So, you just have to ignore the price and walk in and say, fill her up, thanks.
Yeah, you're a price taker. Got no power there. Oh, what am I going to do? Got to buy my pint. Yeah. But you say that, how many people actually know?
True.
When I buy beer, I'm just throwing my phone at the card reader. I got no idea how much the individual beers cost. And if I came back 10 minutes later and they were a little bit extra, I'd have no idea. I wouldn't even notice.
Yeah. And a bit like we were talking about streaming services last week, the model hasn't changed in a long time. It's kind of ripe for disruption somehow. The pricing model for beer in pubs really hasn't changed since we were selling horns of mead for 3 gold nobles. So maybe there is room for a change to the model. Do you think maybe we could even see a subscription service, maybe $20 a month, unlimited streaming from the taps?
It is possible now. It's easy to just ring it up in the tills and have you could have minute to minute pricing really if you wanted to, depend as a function of how many people are in the pub at any given moment.
But it's going to hurt. It's going to hurt people who go to the pub, because if they go, I'm going to leave when the pub starts getting busy because the beer's going to start getting more expensive, then you're probably going to get stung by the Uber surge pricing, who's now ferrying people to the pub, which is the reason it's busy. So it's a double whammy for pub goers.
Yeah. I actually thought it was interesting that this surge pricing sort of been I think it sort of started with these rideshare companies, but the CEO of Lyft, David Risher, is saying that they're trying to get away from surge pricing because customers hate it with a fiery passion.
Oh yeah, but usually when people have had a few drinks, they don't get so upset about things. They tend to behave in a much more calm and rational manner.
That's reasonable.
Yeah, I see what you've done there. That makes sense. It's very busy in here. I'll just leave quietly. I don't think it's going to work.
This is the way of the future. I reckon for sure they're going to bring this in.
Really?
I think, yeah. This is the thin end of the wedge. They're doing a 20p increase on a pint, which average cost of $4.30. So it's pretty small, but I think they're rolling it out to see how it goes. And why not? I don't think anyone's going to stop them. And when it's busy, until it gets ridiculous, there's no reason why, at 10 o'clock at night, the beer has to be the same price as 10 in the morning.
Not advice to buy beer at 10 in the morning, by the way. Don't recommend it.
Yeah, no.
That's fair.
Go long in the AM, go short in the PM.
if you hit it hard at 10 a.m., this is the CVE advice, hit it hard at 10 a.m., and then by the time surge pricing kicks in, you'll be sozzled. Well, it's going to impact going to the pub with your mates, though. That's my problem with it. So, like, because you'll be like, should we go to the pub? And then you'll be like, well, yeah, but I reckon Tony shouldn't come because any more than three of us might trigger some surge pricing in the pub. Sorry, Tony, you'd have to stay home. Especially if Tony's an Uber driver. Then you just call him later when you can beat surge pricing two ways.
Yeah, I reckon there'll be like there's a fuel watch app.
Oh, definitely.
There'll be like a pub watch app, like which pubs are empty and not. Yeah, I reckon that's we should get ready for the future. There's a business idea.
Or just get used to drinking Forex or something that people don't like, which is very unlikely to ever be affected by heightened demand.
I don't think it's beer specific.
It should be.
Should be.
All right, let's leave it there. Thank you so much for tuning in. That is all from us. Until next week, it is bye for now.
Comedian V Economist is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Comedian V Economist are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Comedian V Economist acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.